So, being a real estate investor in 2023 is very difficult because home prices are still high, interest rates are surging, and rents are now going down. So, it's not very profitable to be a real estate investor right now. However, I have some good news. There's certain cities in America where it is actually still profitable to be a real estate investor, even in today's challenging environment. And in this video, I'm going to talk about those 5 cities in particular and walk you through the methodology and the data that I came up with to identify them. And really, the first thing to understand is that right now, cash flow matters more than ever in terms of buying a real estate property. No longer is it acceptable to just overpay for a property and get a minimal return and hope for the best into the future. Now you do really need high cash flow return and a high cap rate from day one to pay your cost of debt and to also cover the opportunity costs that you're missing out on by investing in bonds. Because right now, the US 1 year Treasury yield has surged all the way up to 5.2%, which is now above the average cap rate or rental profit in America of 4.7%. So if you were buying the average house in America, you're making less than if you were to buy a 1 year US Treasury, which obviously isn't good. You want to buy a house and rent it out and earn more than this. You can see historically that we're in a completely different situation than we were for the last decade when the rental profit was higher than the Treasury yield. During this period, it was just a no-brainer to buy real estate anywhere, but now it's not a no-brainer to buy real estate anywhere anymore, and you really need to focus on the markets and areas you're buying in. And the first thing I would prioritize if I were a real estate investor who was value-driven and prioritized cash flow is I would look at higher cap rate markets. The cap rate is a very simple calculation. It takes what your net rental income would be as an investor who owns a property and rents it out and divides it by your purchase price, basically telling you your annual unlevered return. And as you can see, when we go on Reventure app, there's lots of variation in cap rates throughout America. In the Southeast, you can see these areas in red have higher cap rates, meaning higher returns. Whereas if we go to the, let's say, mountain area of America or the Pacific Northwest, up in a place like Seattle, we can see the cap rates are much lower. And so what I would say, if you're a real estate investor, is I would want to focus more, if you're picking a market, on these areas in red. It's kind of like your first hurdle or criteria. And in just one second, I'm going to reveal the markets with the highest cap rates in America where you could kind of start your search and focus. But first, I just want to explain why cap rate and initial return is so important. Because say you have two different markets. One such market would be Greensboro, North Carolina, where the cap rate is 6.9%. 16,000 in net rental income for an investor divided by 240,000 home price. 6.9% is not bad. Now, compare Greensboro to a market on the West Coast like Sacramento. In Sacramento, you're only getting a 4.2% return, 24,000 net rent income on 564,000. So that much lower return from day one in Sacramento just creates way more risk in terms of your investment, especially at this point in the economic cycle where a recession is either already here or coming into the future. Having such a low cap rate basically means that you don't have a lot of margin for error. If there's mortgage defaults or foreclosures, or if prices go down more or rents go down more, your low cap rate is going to leave you in trouble in a market like Sacramento because you don't have much room to work with. Comparatively, if you're in Greensboro and you're earning 7% from day one on your rental, you're putting money in the bank right away. You have a much greater margin for error in case prices go down further in Greensboro, or say maybe rental rate growth stagnates or property taxes go up. Well, that's not great, but at least you're earning 7% from day one and you have that money in the bank and you're going to continue to bank that profit. And so that's the appeal of a higher cap rate market, is it not only does it give you more cash flow from day one, it lowers your overall risk profile. It lowers the amount that you're banking on future growth to make your investment worthwhile. And using the filter section here on Reventure app, you can actually target the markets with the highest cap rates by adding a filter and saying, let's only look at markets with, say, a 6% minimum cap rate. And immediately you see that cuts off like half of America. Pretty much the entire West Coast is gone because the returns there are so low, they're not very high. So if we want a minimum cash flow and a minimum cap rate from day one as an investor, we are looking in primarily the Midwest, let's say parts of the Northeast, the Midwest, down into the Southeast is where you're going to get your best returns as an investor. But it's not only just about cap rate. There's other factors that are also very meaningful because you could buy into a certain city that gives you a good return from day one, but maybe there's no real growth prospects in that area, so you're not going to see much rent growth or appreciation in the future. Or maybe you buy into an area and the property taxes are super high or they're going up fast, and that eats away at your return. There's other risk factors that you should pay attention to as an investor or a home buyer as well. And let's talk about actually that property tax piece, because I think the property taxes are very important. Because again, if you're someone trying to maximize value and get into the best area, you should avoid higher property tax locations, because literally you're just giving money away. You're giving money away to the tax collector if you buy a real estate investment property in a place where the tax rate's 1.5% or 2%. And we're looking at by state, and you can see the highest taxes would be in a state like Illinois. Tax rate's 2.2%. So while the prices in Illinois are cheap and the cap rates aren't bad, the property taxes have me concerned, because if you pay 2.2%, that means that over the course of like 20 or 30 years, you're paying over 50% of your purchase price to the tax collector each year in expenses. That's not great. We can also see property taxes are high in the Northeast, as well as other parts of the Midwest, as well as Texas. Texas is a sneaky high property tax location, 1.74%. That's just money right off the top that you're never going to see as an investor. Conversely, if you look at some of these areas in the Southeast, you can see much lower property tax rates. In Alabama, the property tax rate is 0.4%. The average property tax bill is less than $1,000 a year in Alabama. Compare that to a place like New York, where it's $7,500 a year. Huge difference for a real estate investor right there. And so the 5 cities I've identified as the better places to buy real estate in 2023, they have high cap rates and low property taxes. That's a great start if you're an investor right there. But of course, again, it's not everything, because growth is also important. If you buy into a city, you want there to at least be some baseline level of growth. You don't want it to be losing people. You want, some level of people moving in. You want some organic population growth in terms of births being greater than deaths. That's going to lead to more demand for real estate into the future. Now, you don't necessarily need to be in a city where the growth is crazy. I would actually recommend staying away from crazy, crazy growth markets, because those tend to be the biggest bubble and crash markets. But at least a minimum level of growth I'm really looking at to determine growth here, and there's several different metrics you can do, but on ReVenture we have a metric called migration as percentage of population. And what this filter does is allow us to see how much migration there was in 2022 into these markets as a percentage of the population. If we kind of just zero it out here, we get rid of all the markets that lost people. So you could see all of a sudden like California is gone, a lot of New York is gone, parts of Louisiana are gone, because we lost people in Louisiana, Mississippi, and Illinois. So we don't necessarily want those markets. What's remaining are the areas that gained people in 2022. And if we really want to get more specific, we have this migration filter, right? Let's add the cap rate filter on top of it. Go 6% cap rate. All right, so now we've really whittled it down, and let's also do the property tax rate. And we are now left with a collection of markets, everyone, that understand this, are growing in terms of people moving there, have low taxes, and have higher returns. That's kind of the best of both worlds for real estate investors. And you can see they're almost uniformly in the Southeast. We got a bunch of markets here in Florida. We got a bunch in Alabama and South Carolina, into Oklahoma. And this is really where, you should start to be looking. If you're an investor who's intent on buying today and you don't want to wait, these would be the better areas to do it. However, I have some concerns about some of these markets. Like Florida is one where I think I wouldn't buy in. And the reason I wouldn't buy in Florida is because it's super overvalued. I have a metric here in ReVenture called over undervalued percentage, which shows you how overvalued housing markets are compared to the historical norms. And you can see in a place like Miami's 31% overvalued. That's derived by looking at the relationship of home value to income, which is now 6.8x in Miami. You can see that that's even higher than it was in the '06 bubble. So Miami, more expensive today than it was in the '06 bubble, right before there's a 50% crash. This makes me nervous. So even though Miami does have low taxes, higher cap rates, I'm nervous about buying in here because I don't think it's going to protect my principal very well. What I would also do here, folks, is on ReVenture I would do a filter for over undervalued percentage, maxing it out at around 25% overvalued, and say, okay, I know lots of housing markets overvalued right now, but I don't want to go above 25% overvalued. And so now I'm left with even fewer cities, and we're getting closer, folks, to our top 5 housing markets for an investor here. And just before revealing that list, I just want to highlight how important it is to use kind of solid methodology and data to construct the list of the cities or the neighborhoods that you buy real estate. Because you can also do something very similar on ReVenture app here, looking at zip codes and counties and kind of filtering these areas by what your requirements are. Because most real estate investors, when they buy, they don't have any clue about any of this, and they're just going off of either gut instinct, or they're going off what realtors tell them or what other investors tell them. And what concerns me about that type of behavior is that there's so much groupthink in real estate. This is something I've witnessed in my decade almost of working in real estate, is that literally, like, if there's a hot market or a hot area, everyone just kind of repeats that it's a hot market or a hot area, and people are like, oh, that's a good place to buy, without doing any validation if it actually is a good place to buy. And so that's so important for you to do as an investor, so you avoid the groupthink. You think outside of the box, but not kind of in a risky way. You think it outside of the box in a data-driven way, almost using Moneyball for the US housing market. If you ever saw that movie or read the book Moneyball with Billy Beane, this is kind of what they introduced for baseball and evaluating baseball players. Use data that necessarily not everyone else is looking at, and that's going to give you a chance for achieving higher returns and more stability in protecting your capital. But really, folks, the one last thing I would do here to filter this list down more is to filter for population, because I don't necessarily want to be, if I'm an investor, in a metro with 12,000 people. I think I want at least 250, maybe 350,000 people in my population as an investor, just to have like a base size, right? So, we're not in a place that's too volatile or whatnot. And we are now left, folks, with, like, you can see it's like 10 markets here, which are, let's just say, would be my real estate investor picks for 2023. And we can actually go into table view here. I'm going to actually change the data point to home value growth so you can see here. And these would be some of the markets: Fayetteville, North Carolina; Greensboro, North Carolina; Tulsa, Oklahoma; Tallahassee, Florida; Augusta, Georgia; Montgomery, Alabama; Columbia, South Carolina. What I want to focus you guys on, the thing to note actually about some of these markets is home value growth is actually really strong over the last year, which gives like some validation to this list, right? Greensboro 7%, Tulsa 7%, Tallahassee 7%, Augusta 7%, Montgomery, Alabama 6.4%. Like, these markets are all doing way more than the US average home value growth over the last year. Home prices are going down in many markets over the last year. They continue to go up in these markets, which is validation that this methodology is already proving out to kind of be correct, and that targeting higher cap rate markets with less overvaluation and lower property tax rates, yeah, you're probably going to do better as an investor by doing that than targeting the opposite cities. Now, this isn't a guarantee. I'm not saying that these cities are going to do the best 100%. I actually think some of them will have price corrections. I think prices are overvalued in a bunch of these cities, but I think they're going to perform better than a lot of other areas. And oh yeah, one last thing, everyone. The other thing I would also want to filter by, and you could really go nuts with these filters, folks, if you want. There's a lot of different ways to kind of strategize and categorize these markets, but building permit percentage is also one I would look at, because I would want to avoid markets with lots of home building at this point. And this is where Florida is going to get crossed off the list. If we do building percentage at like 1% or maybe 1.5%, and the way that's calculated is dividing the total building permits by the number of jobs in the economy, we kick Florida out because what worried me about Cape Coral and some of those other markets, there's so much home building right now that's going to flood the market with inventory in future years. But this is kind of our list now of adding that additional layer of less home building. These would be the best markets for investors. All right, guys, I hope you enjoyed this video. It's a bit more focused and specific than most of my other videos, but I just want to make sure that a lot of you guys out there see that we're in a bad housing market right now. Housing downturn started, prices have started going down, but all hope is not lost if you're a home buyer and investor who wants to buy in certain areas. There are still parts of America where it's, I'm not going to say great to buy, but decent to buy based off the underlying metrics. So hope you guys enjoyed this video. Let me know what you thought in the comments.